All right, traders, how we doing on out there? Who's ready to go ahead and get, of course, stock market movers started here? This is the show where we give you guys the headlines and get to two expert opinions. I'm super excited to get in today's show. We're going to talk about some Fed talk out there, some Nato changes, Carnival, what's going on there, PCE, we'll touch a little bit about General Mills, Bed Bath & Beyond, Disney, more. We got some crypto action going on out there. There's a lot moving. We got a lot of headlines to get into. Like always, our guests today are going to be JD Hatfield, founder and CEO and portfolio manager of Infrastructure Capital Advisors. And of course, Jay Woods also joining us from the New York Stock Exchange floor, chief market strategist at DriveWealth. Super excited to go ahead and get into today's show. We got some great guests on, but of course, we got to get through our topics. So let's go ahead. Let's dive on in and welcome to Stock Market Movers with Money Mitch.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch.
All right, traders, how you guys doing in this market? I know it's a tough one, a lot of some chop action. We'll be getting into the chop action that's out there and why it possibly could be happening with Jay Woods. That's at 145. But stick around also for, of course, Jay Hatfield at 115. I'm super excited to get into that. We'll talk a little bit about some macro stuff that are going on out there, quantitative tightening. Super excited to get into that interview. But before then, let's knock out some of these headlines and get through it. A lot going on today. We could take a look at some PCE prices for Q1 here at 5.2 versus the 5.1 estimate. Prior was at 5.1. Core PCE prices were at 5.2 versus 5.1. Looks like I repeated that one there. Don't know why. Looks like I missed one there. But we also got GDP for Q1 at 1.6 versus the 1.5 estimate there. I think it's important to definitely keep these economical data on our radar. A lot of us are keeping on watch how inflation is coming in. Do we see that topping action? I think we get the next number tomorrow on that PCE. So keep your eyes on. We'll see what happens there. Let's keep going. Let's go into what I saw out there from Fed Reserve Bank. Cleveland President Loretta Meiser said that she would advocate for a 75-point basis hike rate. I think this is important to kind of keep on watch. Of course, everyone's eyes on Jerome Powell, but of course, the Fed come together, and if she's leaning towards a 75-point hike rate, who's not to say that doesn't, maybe Bullard join in that camp. We'll definitely keep on watch. She did state that I haven't seen this kind of inflation numbers on this side that I need to kind of think that we go back towards a 50 increase. So at least for right now, she's not seeing that turnaround in inflation that she needs to kind of recommend more of a 50-point basis hike rate. She's looking at that 75-point. I think it's important to keep that on your radar. A lot of what we need to kind of watch also is how do we kind of deal with Jerome Powell right now, and where is his eyes going to, right? So today you got some conversation here from Jerome Powell. Jerome Powell talking about, he vowed on Wednesday with the ECB forum that U.S. policymakers would not allow inflation to take hold of the economy over the long term. The risk is, and I'll go ahead and I'll give you guys the quote here. The risk is that because the municipality of shocks, you start to transition to higher inflation regime. Our job is literally to prevent that from happening. We will prevent that from happening. And the central bank leader said, we will not allow the transition from a low inflation environment to a high inflation environment. I think this is what we're already seeing, but he's trying to state here that we won't see that sustained high inflation. Another thing that he states here that I think is definitely important is as you get deeper onto that, he also states here, is there a risk of going too far? He said, certainly there is a risk. I wouldn't agree that it's the biggest risk to the economy. The biggest risk, the biggest mistake to make would be to failed to restore price stability, stated by Fed Chairman Jerome Powell at that ECB forum. And you guys can see, I think he's clearly stating what's important here, not market prices, but of course, taming that beast, which is inflation right now. Also in news, I mean, I know that a lot of people are probably paying attention to it, some talking about it more than others. We try to get through all the headlines here and touch as much as we can. So I do want to touch the Western military organization, NATO, has officially invited Sweden and Finland to join the alliance in the historical move on Wednesday. It's definitely something to keep an eye out. We've been getting more and more comments. NATO's Secretary General announced earlier in this week that they would be increasing the troop number from 40K to 300K, which is also definitely on the radar. And then Russia coming on in here and calling the NATO expansion deal destabilizing. I think this is something to keep on watch. Of course, I don't want to see more action from Russia, but it's something that we all need to kind of keep our eyes out to see what happens here now that there's more countries here on the borders of Russia that I think, you know, I don't think they were too happy about hearing this news. So I'm not saying that something's going to come out of it, but definitely keep your eyes and ears open, guys. All right, let's keep going. Let's take a look and get out of kind of the macro talk here. Let's go into a little bit different talk. Let's talk about the cryptocurrency hedge fund here. Three Arrows Capital falling into liquidation. We've put up the red flag here a lot on these cryptocurrency platforms. Not saying that you guys got to make that decision of getting on out, but of course, we've been seeing way too many headlines here in cryptocurrency concerns. A significant moment here, seeing a hedge fund here, Three Arrows Capital, falling into liquidation, and Bitcoin also falling through the $20,000 level. Something to keep your eyes out. Where is it going to stop? I don't think anybody truly knows, but one thing I know for certain is there's definitely concerns in the cryptocurrency environment right now. All right, let's keep going. Let's talk about Morgan Stanley's analyst, Jamie Rollo, stepping up to the plate today. He remained cautious on the underweighted rate Carnival Corp. He also put out a chunky forecast. You guys can take a look here. He slashed the price target, a new street low of $7 from $13. He also stated there that lower full year 2022 earnings, EBITDA guidance mirroring weaker than expected occupancies, weakened pricing, elevated unit costs, and of course, higher fuel costs. I know that's one thing we've all seen. He also went as far as, and I got to give it up to the man. He went for a zero bear case here. He's talking about if there's a new major demand shock to materialize. He also talked about if there is that demand caused by trip cancellation and weak bookings. Hence the customer deposit outflow. That's what you kind of want to keep on watch. He said liquidity could quickly shrink, even though leverage looks unsustainably high. We think that with net debt remaining at $30 billion for the foreseeable future, nearly triple its pre-COVID level, they need to keep an eye out on this. He said that he's looking for this to come back down to $20 billion, which implies a $12 billion equity raise, which is very similar to Carnival's market cap. So he definitely sees that if there is going to be some kind of raise there, capital raise, that it could be very dilutive here and could be challenging due to the market cap. So keep that on your radar. You guys can look more into that, and we'll definitely keep on watch. Next area that I want to get into is Bed Bath and Beyond. But before we do that, let's take a quick look at the SPY and see what we're seeing in the action right now. In just about a minute or two, we will get into our first interview. But I do want to see if we can finally get out of this hourly range. We've kind of just stuck sideways on this hourly range. It is showing a little bit down towards the downside now. But you could see, these are the pure examples of kind of that chop market. And it's hard to trade when you're getting that action and you're not getting a complete trend in the overall market. So definitely, we'll see if we actually get this trend to come on in and play here. But the SPY, definitely some chop action on out there. Let's take a look here at Bed Bath & Beyond before we get into our interview. This one coming down here in the pre-market. A lot of this based off of course, announcing Wednesday that the CEO, Mike Triton, is leaving the company. Loss also was based on the earnings that were out right now. The loss per share of $2.83 versus the loss of $1.39 expected. And revenues here were at 1.46 when it was expected at 1.51. So definitely Bed Bath & Beyond just getting hit hard here, down towards $5. Since the open, we're down a little bit here, gone down about 7%. But keep this one on your radar. Definitely one that's getting hit hard, and we'll continue to see how specialty retail kind of bounces back. Retail numbers haven't been the worst, but definitely Bed Bath & Beyond not coming out with the numbers that investors wanted to see. All right, that's going to do it for our first round of headlines. Like always, this show's about getting to a lot of headlines, but even more is it about getting towards the experts. Coming on up, we got JD Hatfield. I hope you guys are excited in the chat. Let me know. Definitely smash the like. This is the founder and CEO and portfolio manager of Infrastructure Capital Advisors. We'll go right into that after this trailer, and smash the like, guys. All right, let's go ahead. Let's bring on our first guest here, JD Hatfield, founder and CEO of portfolio manager of Infrastructure Capital Advisors. Welcome to the show, Jay.
Hi, Mitch. It's great to be on again.
Definitely, it's great to have you back. Last time I was, just Money Mitch, now stock market movers, really trying to get towards the information out there to help the retail traders out there. So thank you for coming on. Like always, guys, this isn't financial advice for educational purposes only. But let's go ahead and dive right into this. So, of course, there's a lot going on right now. One of the first kind of questions that started off, let's keep it basic. How do you see the market sentiment right now and overall kind of moving?
Well, Mitch, what we've been looking for is, as a catalyst to stabilize the market, is for treasury bonds to stabilize, which we've been saying it would happen around 3%. It's probably better to say 3.5%, 3 to 3.25%. But we've seen that stability start to set in. And the reason that's critical is that's the biggest input to coming up with a fair value on the S&P. So right now, at today's interest rate, our fair value estimate is about 4,200. So it means we're about 10% cheap. So that, if treasuries hang in where they are now, that will be support for the market. We did see the market bounce at 3,700. We're trying to hang in here at 3,800. But keep in mind, and this is probably the most important point that I can make, is that generally speaking, you want to be in the market when companies are reporting earnings, and you want to be cautious or out of it or hedged or have some cash when they're not. Because when they're not, hedge funds tend to short the stocks. They don't have to be worried about any announcements coming from the company. And so we've had the kind of the normal, even though this has been a bad market this year, it's pretty normal to have a weak June, a weak September. Those are the months before the companies report.
Excellent. Something definitely to keep on watch there is how we kind of continue out here. Now, one thing I did see is a tweet by InfraCap. So if you guys want to follow that, that's all that's the tweets coming from Infrastructure Capital Advisors. Check that on out. I put it up in our tweet. You guys put out a tweet that said the Fed executed 136 billion of quantitative tightening last week. So let's go into a little bit more of that understanding on the Fed and quantitative tightening. What is happening here and how is it having an effect on commodities?
Well, first of all, Mitch, that's a fabulous question because really almost no investors are focusing on this dynamic. It's a little bit complicated, but it's worth mastering even for retail investors. And that is that the Fed can control what's called the monetary base, which is really just money, regardless of how many securities they're purchasing. So they purchased 9 trillion, but they offset about 2.5 trillion of that through what's called open market operations, which is how they used to control interest rates. So you would have thought, if you just listened to the news and the Fed, that they were being completely irrational and buying securities when we had this inflation, but actually they were offsetting that. In fact, they've offset it so much this year that they've shrunk the money supply, or really just money, simple way to think about it, by $950 billion. And we think that's the critical dynamic. You mentioned crypto. I don't know if we said it on the show, but we have had a 20,000 target for crypto, but not now when it was at 3,500 and 40,000, 35,000 and 40,000. And the reason for that is so when the Fed sucks cash out of the capital markets, it tends to deflate all securities, but the riskiest ones the most. So that's why you've seen profitless tech, meme stocks, crypto get completely smashed, crash really. Altcoins are down like almost 90%. So you don't want to be in the highest risk assets when the Fed is taking that capital out of the markets. Sort of the opposite of during the pandemic, they announced they were going to intervene. That was the perfect time to come back in the market. That was basically the bottom of the market, about 2,200 in S&P. So I would urge you can follow us on InfraCap, or you can do it yourself. It's H.4.1 and look at the Fed's balance sheet. I've been doing it since I was in college, so you can rely on me to put that out as a tweet. But if you do that, you'll be ahead of 99.9% of investors because they're not focused on the Fed's balance sheet, but it's absolutely critical. And to the extent they have the ability to accelerate that, taking capital out or slow it down. So it needs to be watched every week.
100%, Jay. I would argue that, and I would actually not argue that, I would actually support that, because one thing that I was watching since January, and this has been now, 5 or 6 months, every time we get more and more mentions of not only, interest rate hike rates, but also the actual balance being wiped off, and how we keep getting more mentions. What rate this is going to be is another thing, right? We had one kind of rate that was put out, and then when they finally put out the structure, it was a lot less of the selling off. So I've been watching that to see how the selling off of the assets continues to move, something that you guys are watching very closely on Infrastructure Capital Advisors. Let's keep moving. Let's start talking about maybe the June lows. Do you see maybe potentially us taking those out?
Well, we're near term. I mean, bullish is too strong a word, but near term constructive, because we're headed into the July 4th weekend. So the next 2 days trading are going to be slow. The next week should be relatively slow, and then you have earnings season. But as I mentioned before, that's really why you own stocks. You think they're going to do well, and our view is that the economy is relatively strong, will remain relatively strong. That is not go into a significant recession, which we could get into if you care. But in that context, earnings should be strong. Obviously, for a lot of companies, we focus on energy pipelines. Most defensive dividend stocks are likely to report strong earnings. So that should be a catalyst that at a minimum stabilize the market, but possibly cause a rally, depending on, particularly if big cap tech stocks beat. Then the only caution is that normally we get back into that season that we are experiencing right now, which is August, September. You don't have any news flows. So what's to keep either you from selling or a hedge fund from shorting the indices? So we don't think we could go lower than we have in June and September, September, October timeframe. But for now, we think maybe we go back to 3,700. But I don't think people are going to want to get too short going into earnings season.
Definitely earnings something to always keep on watch. Now, I would like to see how you guys see inflation right now. Do you see some topping out, or are you just looking for signs of that topping out in the inflation?
Well, it's a little bit of an awkward situation because the commodities, almost all commodities, have come off 20% over like the last month, including grains. Oils was 20, now it's down about 10. But the problem with that is it really didn't happen until, just a couple weeks ago. So the June report is they measure CPI early in the month, usually between the first and second week. So the June CPI that gets announced in July is likely to continue to be hot. And you're also in the middle of travel season, so you have high airline fares. That's also support for energy stocks. Electricity tends to be more expensive. So we don't think you'll get any signs of a slowdown until August when you get the July report, which will reflect a lot of the reduction in food and energy prices, particularly energy, because that flows directly through. So we do think the second half, and particularly the fall and winter, will start to show that decline. And we also think that Europe's likely to go in recession. So it's entirely possible, if the Fed has any sense whatsoever, which is not clear, that they would start to become more dovish as the year progresses.
Definitely something that I've talked about with multiple people, that if we do finally start seeing kind of that inflation start showing topping signs, how does the Fed react, right? Now, another thing that we got today was comments from Federal Reserve Bank of Cleveland's president, Loretta, talking about a 75 basis point hike rate on the next month's meeting. How do you feel about these comments, and do you feel like the Fed is still playing behind the ball here?
Well, I think that our Fed has been basically poorly managed since Greenspan left. And that's kind of the most obvious example of that is the transitory notion of inflation. What the Fed tends to do, particularly this Fed, is they tend to ignore money or ignore the money supply that I was tweeting about. And so they then are perpetually behind the curve. So they missed the run-up inflation, and they're missing the fact that shrinking the balance sheet, you mentioned January, we really shrunk since January, 950 billion, which is enormous. That's 15%. So they fail to anticipate the impacts of what they're doing to the money supply because they're really Keynesian and focused on supply side and the labor markets. So they're going to be behind the curve. They're going to be pretty clueless. You'll notice Lagarde is going slowly because she's, I think, more competent than particularly Fed Chair Jerome Powell, who's really a politician, trained as a lawyer and in politics. So I think there will continue to be ultra hawkish, which is a mistake because there's a lag. But like I said, when Europe starts to go in recession, when these commodity prices start to really come off hard, when the housing market finally shows signs of slowing down, hopefully they'll start to realize that there's a delay between their actions and the real economy and go more slowly and not take us into a significant recession.
Definitely something to keep on watch. And then, like always, I've said it before, I always feel like the Fed plays the game of extreme. At first, we had an extreme quantitative easing. They were injecting a whole bunch of money. Now they're completely on the opposite side. We'll see how that kind of plays out. So what should investors really kind of keep their eyes on, to kind of show signs of bottoming action? Of course, it's not about catching extreme bottom, but what should we all kind of keep on watch to show us that we're finally getting that bottoming action?
Well, I definitely watch the bond market because that's kind of the oxygen for all asset classes, including real estate. Everything is a spread over treasuries. So if we're correct about the 10-year treasury hanging into the 3 to 3.25 level, then that stops the pressure on valuation. And then it switches over to earnings because the two inputs on valuing stocks are what discount rate you have and what are the earnings. So if we continue to have that stability in the 10-year, then the critical element will be earnings. And we're going to get that data in a couple of weeks. And as I mentioned, we believe, particularly the sectors we follow, defensive dividend stocks, pipelines, the recovery REITs, utilities are likely to have very strong earnings, and even mortgage REITs. And that's where the short sellers get burned, or even the long sellers who panicked get burned because they realize, yes, there are a lot of challenges to the economy, particularly globally, less so in the U.S. because of the energy crisis in Europe, which benefits the U.S. So that will be the real evidence to prove that the U.S. is the strongest economy in the world, and our companies continue to do well, and you shouldn't just sell them into oblivion. So I would watch interest rates and earnings.
Of course, definitely. We're going to keep on watch those two items there. I wanted to go ahead and thank you for coming on today, Jay Hatfield. And if you guys want to continue following, of course, I would suggest staying with InfraCap. They put out a lot of information. I follow them there, so I definitely recommend the audience go ahead and do so also. Jay, where else could we find you? Is there anywhere that we can maybe follow you specifically?
Well, we don't have a lot of staff, so if there's a tweet coming out on Twitter, it's most likely that I wrote it, or it's
you see,
or it's like a video like this video might be posted there. So that's probably the best place. And we do have a lot of information on our website at infracapfunds.com that has information about our funds, and also we post our monthly commentary. And you can go to our website and register, and we'll send you, and we should send this to you as well, Mitch. But we summarize everything we just talked about, kind of a bullet outline form, outlook for the economy and the market. So that's another way you can get on our mailing list, and we can send that to you monthly.
Awesome. I love that. I did get a question from the chat. They were asking about the address that you referred to for the FUD budget. And the balance sheet, where can they check that out?
So it's actually, I always Google it, which here. So I just say Federal Reserve H.4.1, and that'll get you to a sheet that gives you every release. And so then you can just look at the most recent release, and then in that release, it'll take you a little while to study it, but I'd recommend doing it. I've been doing it for 40 years. And study the changes. They give you all the changes. So it's Federal Reserve H.4.1.
Boom. Chat, there you have it. And like he says, study it, kind of learn from it. I appreciate you giving us that insight, Jay.
Yeah, and also look at our tweets, because we can interpret it for you. And I studied monetary economics when I was in college, and I've been studying it for 40 years. So
that's what it's all about, right? Giving the information and trying to stay in the informational edge. One of the things that I always want to do with this show. So thank you for coming on here. Jay Hatfield, the founder and CEO and portfolio manager, Infrastructure Capital Advisors. We'll definitely have you back on, Jay.
Thanks, Mitch. It was great again.
Always. All right, let's go ahead. Let's keep on going with the headlines. We just got through another expert opinion there, and that's what it's all about, really. I want to get you guys in the informational edge. I want to touch as many headlines as we can. If we can get through all of them, then we'll get through all of them. Like always, I have so much value trying to give you guys back, because you guys need to know the information. And sometimes it's hard to look around and get all this information. I try to get it all to you in 1 hour plus 2 interviews. So give me a thumbs on up. Smash the like. I've been hearing too often that I haven't been asking for the likes on this show. So do me the favor, guys. Smash that like on up. See if we can maybe get to 100 likes today, so that we can get towards our next interview, because I'm super excited. He's going to actually be joining us from the New York Stock Exchange floor. So if you guys are excited about that, hit the like button, and let's keep going with some of the other topics on out there. So we just talked about Bed Bath & Beyond. Let's go into Disney, because I think it's an interesting stock. I was keeping an eye on it yesterday. It was holding up for a while, and then boom, the gains just couldn't hold on. It just got knocked down. News being released here that the Walt Disney's company board, this was released yesterday in the afternoon, that it unanimously votes to extend Bob Chapek's contract as CEO for 3 years. So this is very, controversial out there. But you could see today, Disney coming on down on that news. So it's looking like right now, market's kind of filling in here. But it does look like we're getting that fill into the shadow zone. Yesterday, we talked about this, how it was up here. And I talked about how could we possibly get a shadow fill towards the downside. Exactly what we got there on Disney. Now the question is, do we come back to attack the lows, or do we hold here and then just kind of stay sideways? That's what I think Disney investors are looking for. I'll be watching for when it can really close back above 100 because it seems to me like an opportunity, but I need to see it get back up into bullish sense. Let's keep it going with the headlines. Let's go to Shop here. Shopify was doing kind of, we were interested to see how they was going to react with a 10-to-1 split here. It was trading pretty decently in the pre-market, and now you're starting to see the following effects of a 10-to-1. So you guys can see here, we definitely split down, but coming on down here after that. Now it's down to $32. The question is, where does it go from here? I would keep on watch. We talked about this in a little bit in pre-market prep. I talked about the 17 level for me. I think it could come down towards that level. That's the next big layer of support for me. So I'm just going to keep on watch on this one on Shop. Like always, splits have not done actually that well. After we got, Apple and Tesla split, yeah, those did get good. But from there, you guys have seen Amazon. Amazon hasn't done that well. It did run into the split, but couldn't hold kind of some of those gains. We're going to keep on watch to see it. Let's see if Amazon's able to keep holding on. But right now, the splits haven't done the biggest move. I know that a lot of people are keeping an eye on Google to see how that split is going to affect that stock. But right now, it's still on a downtrend. And we'll see. These splits just haven't been doing what they did in the past. And Tesla is now down there to 675. Could get down there towards eventually the split price, right? That was around the 290 level. We'll see if it ever gets down there again to the pre-split split level. All right, let's keep it going. EV Go, what a dog today, says JRP. Hey, who knows? Born, JRP, easy. Appreciate you guys talking in the chat. And also Jay Rice. We'll see what happens there in Disney. Let's keep it going. Let's go to some next headlines here. Let's talk about Snap announcing Snap Plus here. So Snapchat announcing Snapchat Plus here and going down. One of the things that I had talked about on Snap that was a little concerning to me was questions, of course, from the DOJ on algorithms here for Meta, of course, Facebook, and that really put a little bit more of a red flag for me in kind of these names. So I'm not sure if we'll still see kind of the positives here coming from Snap. You should see that it did pop a little bit here towards the bell. We'll see if it can close. I'm looking for a close above 14 to show me that it wants to continue. It did bounce back a little bit here, but it could come right back and take out the $12 lows here. And if you look back here, we're definitely getting back towards kind of those pre-pandemic numbers. And it has a low there of 482. So it doesn't mean that we don't have some more downside action maybe put in here. We'll see how this kind of Snap Plus kind of plays on out. What is exactly Snap Plus? Well, a lot of it's going to be kind of some features that you kind of can get. A lot of it also comes after a disappointing current quarter, which it reports its first quarter result in April, and it just wasn't where it was. It's a subscription plan here, trying to make some extra revenue. We'll see if they're able to kind of get the subscribers that they want from this. So just keep your eyes out on Snap and how it performs. All right, what's going on out there? You want to see the technicals on CPG? I got you. Stick around. I'm going to try my best to go ahead and get into it. Let's keep going. All right, let's go towards the next one here. I think this is an important one to talk about, and it's all about TikTok, right? And so TikTok is actually getting a battle here. This all comes off of Brendan Carr from the FCC. He stated that TikTok is not just a video app, that it's sheep's clothing, that it harvests swaths of sensitive data, and that new reports are being accessed by Beijing. He said that he's called on Apple and Google to remove TikTok from their app stores for its pattern of surreptitious data practices. So here, just mentioning the data issues here. They also showed a dated letter, June 24th, on the FCC letterhead, and said that if Apple and Alphabet do not remove TikTok from their app stores, they should provide statements to him by July 8th. So keep this on your radar. We'll see what happens on the TikTok life. Like always kind of comes into question. Let's go to FedEx here. FedEx, let's take a look here how it's performing on the day. Starting to get a little bit of a rebound. So let's take a look here. I'll put it full screen. You can see us rebounding a little bit here. FedEx is hosting an investors meeting today where the president and chief and CEO Raj and the FedEx leadership team will present a strategic plan to deliver more value to customers, stockholders, and team members. FedEx will also outline its fiscal 2025 financial targets. So keep FedEx on watch. You could see that maybe getting a little ramp up towards the close. We'll see what happened there on FedEx. All right, in a little bit, we'll be getting into our interview with none other than Jay Woods. So stick around for that. I'm excited to get into some of those questions. One of the things that we'll be talking about, let's go ahead, let's take a look at least on the earnings side, which was General Mills. Let's go ahead, let's get into that. It was an interesting report and having some good action here in the intraday. You can see it popped up on that pre-market. Kind of numbers coming out here. Adjusted EBITDA at $1.12, beating the $1.01 estimate. Sales were at $4.9 billion, beating the $4.81 billion estimate. Something to keep on watch as we're starting to see a little bounce back. Of course, we've been kind of watching the kind of moves with value and growth. We'll get into a little bit more with this with Jay coming on up, but something to keep watch. As you can see here, daily chart had a nice push out. And so you can see here how you came back to these highs up here and really pushed on through. So I'm going to be looking for maybe some pullback opportunities here. If it can come on back here, let's say somewhere towards the 73 level, we'll see if it can get on back there. But you can see here, I was holding it as resistance in the intraday. This is the 5-minute, and it pushed on up there towards around 75. We'll see if it can close above and continue the push. And this was, of course, packaged foods. Let's take a quick look at packaged food. This is an index that I use to kind of keep on watch of the industry. And you can see here, kind of that rounding bottom cup and handle here on the industry. Let's see if we can really start ripping, and really make our way back up to these highs that we were at back on June 28th here. Let's see if we can get back there as we've kind of declined and are coming back. A lot of that due to that General Mills number. Like always, we want to take a look at what was hot and what was not. We usually do this at the beginning of the show, but we had so many headlines. I wanted to make sure that we got through all of them there. I know that some people wanted me to take a look at some of the stocks that they wanted to look at, which was CPG. I got you. I'll take a look at that. But first things first, let's do it. What was hot and what was not today. So up on the day, we got healthcare and consumer defensives, but healthcare really the only one that I would really kind of focus towards the upside, up about 0.46 here. Names like J&J not doing too bad today. Really, it was kind of medical distribution and also healthcare plans that kind of led there. UNH not having a bad day, so you can take a look at maybe United Health here. CVS not having a bad day. You got ELV here, a little bit smaller name here, and also Humana also hanging out right now near the VWAP. We'll see what happens with these names. Healthcare plans not having a bad day, up about 1.2%, the industry. And overall, healthcare has been doing well lately. The area that I've been really kind of focusing is biotechs, and you can see here the strength there in biotechs. We'll also talk about that coming on up. We got to keep watch to see if this can continue here. There's been a lot of names kind of making some good push. You can look at Amgen. You can look at Gilead Science. You don't see this move too often. So it did have a couple of days of sideways action, but it really didn't retrace too much. Now picking up a little bit right underneath that 9 EMA here on Gilead. Something definitely that I'll keep on watch. And you get more and more mentions of the FDA mentioning with Moderna and kind of mentions now that we might need to take another vaccine. Of course, I don't think anybody wants to hear about shots, but something to keep on watch. As I was even watching Pfizer today, I did take a little bit of a quick stop out here today, just full disclosure, but I'm completely out of it now. I'm going to keep watching to see how it reacts and continues on the day. But Moderna definitely was showing some strength early on. Looks like Lilly is showing some strength today. Nice little pattern there. We'll see if that can continue. All right, let's go ahead. Let's get into our expert opinions. That's what it's all about. This show is trying to keep us in the informational edge, get through a whole bunch of headlines, and of course, get to the experts that you guys want to hear from. So if there's anyone out there that you guys want on Stock Market Movers, shout me out. You guys can reach out to my email, mitch@benzinga.com, or of course, just hit up the comments after the show. Let me know, and I'll do my best to get them on right here on Stock Market Movers. All right, let's go ahead. Let's get a little bit of some trailer action here, and then we'll get into our next interview. I want you guys to smash the like, and let's keep it going right here on Stock Market Movers.
Introducing portfolio synchronization with your brokerage. Now you can securely connect your brokerage account to Benzinga Pro, opening a world of personalization. Screen lightning fast news just for the stocks you own. Set alerts for news catalysts that affect only the companies you care about. It's all possible with a simple click and a secure protected connection. Overcome uncertainty and connect your portfolio to Benzinga Pro today.
All right, team, let's go ahead. Let's get it started. Let's pump it on up. Let's get excited. Jay Woods is coming on here, New York Stock Exchange Executive Floor Governor, Chief Market Strategist at DriveWealth, joining us from the floor. Welcome to the show.
Hey, it's good to see you, Mitch. How's the sound? We working this time?
Oh, we are on point, looking great.
Right.
Let's go ahead. Let's dive on in. You guys are definitely always kind of keeping on watch. You're on the floor. You hear a lot of action going on around you. Let's first talk about getting into what this end of the month can look like and why we're maybe seeing a lot of choppy action out there.
Yeah, we've had a few events here. It's been an interesting June. We had the Quad Witch 2 Fridays ago. Last Friday, the Russell Reconstitution, the third busiest day in the history of this fine institution. And then, Thursday, which is going to feel like a Friday to a lot of people. I have a feeling Friday's going to be very slow. Sadly, I will be working, but this Thursday is the end of the quarter, end of the month, and end of the first half of the year. So you're going to see some window dressing. Going to see some portfolio managers trying to jump into names. Maybe they weren't in, and they're just going to say, oh, yeah, look, I was in on this name by the end of the year, or by the end of the quarter, by the end of the half year, that is. And, we'll probably see a nice spike in volume. Nothing like we saw the last 2 Fridays, but it's always interesting. And then what we're going to do is we're going to talk about second half prognostications, tough word for me to say. And, a little bit of a look back to the first half because it was a rough one, unless you were in energy, of course.
Yeah, definitely. So what's going to be on your radar for Q3? What should we kind of keep on our radar?
I listened to you, and you've done this to me twice now. You went into some areas that I wanted to focus on.
We'll touch them. We'll touch them. Don't worry. I always got some questions for you.
I don't want to repeat some of the great things you were talking about.
Like always, one of the things that is important is staying with the relative strength, right? And I think I talk about that always is if you can
without a doubt. And you mentioned 2 sectors that I have my eye on: healthcare and biotech. Biotech has stopped going down, and in this market environment, stop going down is better than the stairs we continue to see month to month to month on the downside in the major indexes. So you look at the IBB and the XBI, and that could be a double bottom. We're starting to see some strength there. And then let's look under the hood a little bit. Biogen is a company that I don't know if you mentioned before I jumped on BIIB, but all right, we're seeing some technical progress. It's been one of the most beaten down sectors, in the last year and a half prior to the real big sell-off in the S&P. And I'm starting to see some green shoots there. In the biotech sector, there were 3 that jumped at me, like little names. I don't even know what these companies do, but from a technical point of view, Ionis, IONS, Meridian, symbol VIVO, and then Harmony, HRMY, which is, I looked it up, they're from my home area in the Philadelphia area, so they get extra points for that. But these are 3 little stocks in the sector that are starting to, from a relative basis, acting extremely well. And from a technical basis, we're knocking on new highs, and that's what I like to see. And then you talked about 3 of these stocks before I jumped on in the healthcare space. We got new highs. I like to look at that new high list, and it's not energy names just making new highs. It's not Warren Buffett's Occidental, which is taking a little bit of a haircut recently. It's what are we looking at? We're looking at Merck. We're looking at Eli Lilly. We're looking at Bristol Myers, as Kramer, one of Kramer's favorites. Pfizer acting okay. They're not the most exciting names, and the space I think is down 8% year to date. But if you're looking for stocks from a relative basis that are starting to outperform and turning up, I think biotech and healthcare are some of the areas that you want to focus on.
Definitely something to always kind of watch. We're always looking to find a kind of where's the rotation going or where is the puck going. That's always the kind of question that you want. It's not where it's at now, it's where it's going, right? And so let's talk a little bit about, let's get into a little some micro action. I did see recently, you know, Nike earnings, and it wasn't that bad. It beat on EPS and revenue. Where do you see Nike overall in retail?
Well, Nike, and this is one of the things we talked about down here, you know, that is such an iconic global brand. And, you know, their guidance, they were one of the first to guide and worry about supply chain issues 6, maybe 9 months ago. And you can see it in the chart when it started to really break down. The guidance was what we were focused on. Again, yes, it was great that they beat on numbers. They did guide a little lower, and they beat on those lower expectations. So that's a positive. The reaction from a price standpoint, you know, that 103.5, 104 level, and I'm glad you have the chart up here. It's fighting to hold it right now. We broke down yesterday, new 52-week low. I think we hit it again today, another 52-week low. You know, from a risk-reward point of view, I think it could be a good entry if we can get that close above 103.5, 104 with a quick and a tight stop if it does break down. And, you know, what do? We're going to rally a bear market rally. And this is what we continue to hear as a topic, as a theme across all sectors. But in a bear market rally, we've seen 5, 10, 15% rallies in individual names quickly. And this now is set up from a short-term perspective to possibly give you that quick 5 to 10, maybe 15% back to the 50-day moving average, 117. So it's there where I like to see setups from a day trading, swing trading point of view, that, you know, okay, this thing breaks another dollar. You know what? I'm getting out. I'm cutting my losses. We'll revisit it again when it's on my side. But once again, longer term, it's in a downtrend. No one likes to trade stocks under the 200-day moving average in a downtrend. But it could be an interesting spot to nibble.
Something definitely to keep on watch. I think we all are looking for some kind of plays, right? And we have to keep this in mind. There is going to be some great opportunities that come out of this bear market. So I think it's something that everybody should keep on watch. Now, let's get into kind of one of those headlines that came this morning that I'm sure it knocked a couple people off their socks. Was Morgan Stanley's analyst, Jamie Rollo, stepping up to the plate with his zero bear case for Carnival Cruise Line. What do you think about that? The crazy kind of bear case to zero on Carnival Cruise Line.
That was an aggressive call. And yeah, I mean, they have a lot of debt on the balance sheet. Right now, we know the travel stocks, you know, from the people going to travel, they're acting phenomenal. You know, the log jams at the airport, the flight cancellations, cruises, people are getting back out, they're doing things, but will that translate over the longer term? Will that be able to withstand another, you know, as they said in the Morgan note, another, you know, catastrophic event like a second wave, third wave? I don't know what wave we're on in COVID, but, you know, can they withstand it? And right now, price action is telling me this isn't good. Carnival Cruise Line is about to test the COVID lows when the world was coming to an end. We're back out there traveling. We're back out there on these ships. So there's more to it. And it was a bold call. But, you know, I'm a technician at heart first. I know that people are traveling. I know what's going on. But the market is a leading indicator. And something ain't right here. And the price action, if this doesn't hold that $8, I think 27-cent low from the COVID low, you know, I wouldn't be rushing to put money back. You know, we're not in that day trade era where people are they're going to travel. They're going to get back on ships. Okay, we're doing it right now. What happens come September when people are like, all right, the COVID fatigue is over. I got that trip that I've been waiting for out of the way. And yeah, now we got to cut back on expenses. All right, we're not going to take the next trip. We're taking them now. But what happens after we get back, the kids go back to school and things slow down again?
Definitely. I think a concern is kind of the winter months too. Also, you know, when that comes rolling around, how is that going to be? How's the travel going to be then? I think you are right, and I've been looking at it too, is the price action in these reopening plays are showing us something different than what we're seeing right now. So could be a leading indicator, something definitely to keep an eye out. Now, I wanted to talk to you about, of course, one of the biggest themes that I think investors keep an eye out, which is the EV theme, right? And how is this moving forward? Are you looking at maybe some China names? Do you like Tesla? Or maybe we're just going lucid dreaming. Who knows? What do you like here, Jay?
Well, when you talk EVs, you got to talk Tesla, and Tesla is by far, in a way, the leader in that category. And you have the big car companies, you have the Fords and the GMs in the space. It's these little ones, the Rivians, that was the biggest buzz of all IPOs last year, that is now trading, it's basing, if you want to spin it positively, but it's at 25. It IPO'd at 78. God knows how high it got before it turned. You had a stock like NEO have news out today, and I don't speculate on what people are saying here, but it doesn't look good. The news doesn't read well. The charts, to me, they're churning. They're not going down anymore. But it's one of these. The whole sector is kind of show me, and let Tesla lead the way, and the others follow. And it's a space that it sounds great. The ideas are great. I think we're all going down that road, especially with gas prices the way they are. But why are gas prices over $5 at the pump and these stocks continuing to struggle to go higher? So to me, it's something you avoid. And if you're going to be in this space, I think Tesla's always the way to play it. And even right now, we're seeing a little bit of a chop in Tesla. So that's good. It paused on the, it's not going down. But I'd rather see stocks that are going up and play from strength than trying to pick a bottom in some of these names.
Definitely. Now, one of the things that I've been focusing on is the bottoming that we're seeing a little bit in growth. Also, the value trade was coming off some. And then now we got in recent earnings here with General Mills really kind of getting that bounce back here in consumer defensive names. How do you see here the battle here with growth and value, and where do you see it going?
Well, let's talk about General Mills. What a quarter they just had. And I saw you had that chart. Put that chart up on a weekly basis.
Yeah,
go back
man.
to 20. Go back
Let's
a decade. 72. What a level this is. If you're looking for longer term plays, risk reward setups. Well, this is one of those technician dreams here. If we can trade and stay above 72, it's a stock you would want to be long. Is it a sexy name? No. Is it a great cereal? Yes. You got Honey Nut Cheerios. You got Cheerios, my favorite, Golden Grams. But it is the perfect defensive sector when you're heading into this recessionary environment we are. So these are the value. This is where I would want to be. It's not high growth, but it's value. It's consistency. If people are cutting back, what are they going to do? They're not going to go out as much. All right, guess what? Cereal night for dinner. A favorite of mine, by the way.
Yeah.
So, but from a technical basis, I was looking at this today, and I like to look at some of the long-term charts, and it isn't a day trader's dream. It's not the one stock we buzz about down here on the floor. We were the market maker in Kellogg and General Mills for years. And it's slow, consistent, and they'll have their days in the sun. And this is it. And this could be the place where we now leapfrog and we go on a nice, consistent leg higher as long as we're staying above that $72 level.
Yeah, that's one area that I at least right now, I don't see slowing down too much is the food inflation, right? Because if there's anybody that could probably pass off the cost to the consumer, it's going to be these defensive names, right? And so it's something definitely to keep on watch. I've been watching the price of my Frosted Flakes going on up. I've been talking about it. Might have to switch and then get the frosted off and maybe have to end up with just the flakes. But
yeah, well, wait, the Benzinga people don't provide like cereal, or you just still working from home? Like I'm blessed. The DriveWealth team, they have that fridge stacked, and the Frosted Flakes are there for me whenever I want them. Honey Nut Cheerios. And maybe I'm spoiled. I apologize, but
I'm gonna have to get.
You got to tell Benzinga to please. They got to hook you up with something. You got to eat, right?
Definitely got to eat. And I'll tell you what, I don't think you're not eating too. On the floor of the New York Stock Exchange, I appreciate you coming on and joining us today, Jay Woods. If you guys don't follow Jay on Twitter, I definitely recommend it. Check him on out and definitely check out DriveWealth, guys. Appreciate you joining me like always, Jay. Killing it, and we'll have you back on.
Always a pleasure. Great to be with you. Thanks.
All right, guys, it's going to do it at least for the experts. We're wrapping on up here as we get towards 2 o'clock. Let me know what you guys think of this show. I feel like this show is really the fast-paced action, getting through the headlines, keeping the informational edge is what you guys want. So if you guys want to see something different or want to see something more or less of, hit the comments after the show. Let me know, and I'm going to go ahead and do so. This is the show where we get through tons of headlines. I think we got through about like 10, 12 headlines today. Gonna keep pushing to get through more and more. The biggest thing is you guys run the show. So let me know in the comments, what do you want to see more or less of? And I hope you guys enjoyed our guest today. We had JD Hatfield, founder and CEO of Portfolio Manager of Infrastructure Capital Advisors. Jay Wood, New York Stock Exchange Executive Floor Governor and Chief Market Strategist at DriveWealth. Go ahead and let me know what you guys thought, and hit that thumbs on up on the way out. Up next, what do you guys got? You guys got some, of course, some roadmap action. Go ahead and check out the BBBY lawsuit, top 10 NFTs, and some NFT news, of course, by my man, Chris Ketchy. You guys check him out. He's one of the best in that industry. So if you guys want to stay with him, just go on over to the roadmap. I'll see you guys next time. Hit the like button and keep it going right here on Benzinga.
Thank you.